Unrivaled Nation, one of the most pleasant surprises since I launched this channel is the ability to connect with many of the different users out there. And I interact on a regular basis with my subscribers at Unrivaled Investing, the premium subscribers on our exclusive Discord. But the reality is, you know, when you have a channel of over 100,000 YouTube subscribers, so thank you for being one of those subscribers, you come across just a lot of interesting people. I've met an auditor from Europe. I've met a UFC fighter from Latin America who is interested in interest rates, you know, insurance executive who's built a $100 million business, a entrepreneur, the grandchildren of an entrepreneur that built $1 billion business. You know, so you come across a lot of interesting characters. A lot of it are just human interest stories, you know, the first generation immigrant that's building a business, you know, somewhere. And so I enjoy hearing these stories. I enjoy hearing these challenges, but the reason why it becomes directly relevant to you is because oftentimes, you know, these folks will reach out and say, Daniel, what do you think of this company? And so I do offer a commission video product. This is one of these commission videos. And oftentimes I don't even publish the videos because we will be talking about a private company. We'll be talking about a family-owned company, thoughts about, you know, how do you think about the valuation of it? And lastly, we do talk about public companies. And the reason why I think people sign up for it is because they're used to, on this channel, my no hype take where, you know, love it or hate it, I'm going to tell you what I think about a business. And often enough, because of, you know, my channel and, you know, people's interest, I do get requests for penny stocks. So this video is going to be about one penny stock in particular, but will provide a framework for how you should think about it. Because oftentimes, you know, probably once a month, I get a query from either a member or someone watching this channel and say, Daniel, this penny stock, it seems like a lottery ticket. You know, maybe I should load up on it. What do you think? And the reason why I'm making this video is to show you analyzing penny stocks really isn't that much different than analyzing $1 trillion company. You're going to apply a lot of the same framework when you're thinking about it. So in this video, let's go through that framework, which the truth is, it's the same framework you're going to see in many of my videos. Aligned management. You know, are they cooking in such a way that the minority shareholder, if you were to buy shares, that they benefit and you benefit as the business grows over time? Does it have a compelling valuation? Is there obvious growth potential? Can you say, yeah, with 90% confidence, I think this will be much larger in the future, 5 years from now, 10 years from now? No blow up risks. This is probably one of the tougher ones for penny stocks. And then lastly, is it a win-win dynamic where it's sort of a sustainable business because customers are winning, the business is winning, community, employees, etc. But when I think about this list, and the truth is this does filter out 90% plus of the companies out there. For smaller, riskier companies, penny stocks, the ones that people are like, hey, could this be a lottery ticket type of, you know, opportunity? I think what you need to do is when you think about this checklist, you need to be extra sure that management is aligned. You need to be extra sure that the valuation is really compelling. You need to be really sure that the blow-up risks really aren't there because, you know, you're dealing with something that's oftentimes smaller and less liquid. These are the important things to think about. And so first of all, as always, this is not financial advice. It's a commission video, and I'm going to walk you through, you know, sort of how do I think about a penny stock. In this case, we're looking at Safety Shot. The ticker is HOT. What they market is they claim to be the world's first patented detoxification beverage. You know, so you go out in the town, you get a little liquored up, and the thought process is the next day you're taking the Safety Shot drink, and it's going to make you sharper in mind and body. It could help your body replace your electrolytes and just get you back in the game because maybe you drank too much, you know, the night before. And they're quickly expanding into new stores. So I'm getting the thesis, you know, this is whenever you look at any company, you want to assess what they do, you know, can you see a clear path for them 3, 5, 10 years from now to sort of size up what's the product, does it make sense? And a lot of people at this point, they might say, I'm not really sure. You know, different people have different treatments for intoxication, for getting liquored up. And so that's the first thing. So the next is, okay, you're dealing with some sort of consumer product. Then what's the growth runway ahead of you? And so clearly very small. It's already been in 192 stores. When you're thinking about retail stores, you're talking about thousands of stores. So this is just very early days in terms of the potential. And then they talk about launching in Bevmo stores, 7-Eleven in SoCal, and that they're having conversations. That means no big commitments yet from the big boys like Walmart or Kroger or a Target, but early indications of, hey, this is getting some sort of traction. What I don't like, frankly, about this type of product is that it seems more of a one-off type of dynamic, unless you're getting hammered, every day, which if you are, you should probably stop watching this video and, seek another solution. So maybe this is you're used to a sort of a lifestyle on Saturday nights, or maybe it's Thursday nights if you're a college kid, who knows, where, you're trying to make sure you can do well on the exam the next day, and how do you get to your game. So I don't view this as this isn't like as repeatable as, let's say, a drink, where you're going to say, hey, I'm going to drink this every day. So that is something important to reflect on as you look at this. But they are targeting, a sizable market, around $2 billion. And so it is important to say, okay, so now you have an understanding of what the bull thesis is. They're tapping into a sizable market, clear path to grow as they expand. But then it is important to understand, okay, what's the fundamentals? What's the data telling you? So first of all, the market's giving you a big red flag. The market is saying down 75% in a year. So that's a signal that you go, okay, well, maybe there's something wrong here. I want to dig deeper. Is this just because the valuation went lower? Is this because our fundamentals stink? And then also, when you look at Safety Shot, because oftentimes I'm getting requests about, hey, what do you think of this penny stock? First of all, trading under $1, trading, let's say 60,000 shares during the day and $30 million market cap. This means you're going to have just tremendous upside potential in order to be interested. If it doesn't have that upside potential, it's not worth playing for. And so and also when you have something like that, where it's so illiquid and so small, I do own some small companies. $100 million company, $300 million company, but the profile is very clear that it has beautiful financials, growth, profitability, free cash flow. And so I would need to see that when I'm looking at this. So there's extra bars, extra hurdles that you have to go over when you are looking at a penny stock. And so looking at this, there's going to be more hurdles that you're going to have to think about, as you consider something like this. So let's look at the fundamentals. Fundamentals for Safety Shot, that launching in new stores clearly is translating into sales growth. And their sales growth is fantastic. You can see that going from 12 million to 110 million, in the most recent quarter. They were expecting something like 50% growth, I think, in the fourth quarter, continued, growth year to date. The problem is that looking through this income statement, their gross profit is hugely negative. So in other words, for every shot bottle that they're selling to make people feel better, their cost per bottle is way higher. And maybe this is a volume issue that at scale, this could flip to be profitable. But this is just a huge red flag that they are just so subscale. And that's a big problem. And then not only that, but you have really sizable expenses, operating expenses that are keeping, that's being charged to this. So this is multiple red flags. It's the stock price has been heading in the wrong direction. Yes, sales are growing in the right direction, which is what I like to see, but their expense structure and their gross margins negative. Like, this is just hugely red, huge warning to investors. I would say at this point, too hard for me. And then to top it off, well, how are they financing, their sizable losses? And you can see their diluted share count is growing significantly, meaning that they're issuing more and more stock. And that is not what you want to see. And you could see that year to date, as of September 30th, they were at a sizable cash burn of like $17 million. That's a huge cash burn for such a small company. I mean, that's a huge warning. And you're going to say, well, okay, how are you even financing $17 million in cash burn, especially when you only have like $1 million roughly in cash? So, where are you going from here? That's a very short runway from here. And then, looking at the news, you also see that they recently did an all-stock merger with Yerba Brands. So they are focused on plant-based energy beverages. So the idea is maybe you can get some sort of scale benefit by combining Schott and Yerba. Doesn't jump out to me, especially because they're talking about 12 million revenue in 2023. And since then, Yerba has been collapsing, it looks like, from a revenue perspective. So you're making an all-cash deal for a collapsing business. This is a case study in red flags, things that make me uncomfortable. The negative gross margin, the high operating expenses relative to sales, the huge cash burn, and then doing an all-stock transaction for another company. It doesn't really make sense to me why to do an all-stock transaction for another business. Why not focus on scaling up what you have existing? And by the way, if you look at the Berkshire Hathaways of the world, the exact opposite end of the spectrum, where they have literally hundreds of billions of dollars in cash, they treat their stock like it's gold. They say, we are not going to issue new shares because it's so precious. So for me to see them doing an all-stock deal for a company with declining sales, it adds insult to injury, as I look at this. So too many red flags. And then to answer the question of how do you even, get past the fact that they have such limited cash, is they have been doing several private placements from various different investors, sort of keep them alive. It's unclear if this could even keep them alive for the next year or two. Doing convertible note and a secured convertible note. So they are issuing millions of dollars. They are issuing, a lot of stocks since those financials that I covered. But going through this list, what jumps out to me, even if the growth potential is obvious, even if, they're able to keep launching in new stores, they're able to get a Walmart, for example. The part that instantly makes me say, I can't keep digging into this, is the blow up risks. And that's the reason why, I'm showing this framework for you, because I'm hopeful that you as an investor, every investor is going to have a different journey. And I wanted to provide a framework for you to go, okay, if someone's going to say, oh yeah, I went all in on something, I want you to be able to make your own judgment, to think about, what's the quality of this business, and do you agree with that sort of framework? And when I look at this, the no blow up risk just jumps off the page. It has huge blow up risks as I'm looking at it, because of, the short runway, the huge short runway relative to the cash that they have, the huge losses, using their stock to acquire sort of an unrelated company. Maybe you could say some sort of scale advantage. So I think it's important that if you're going to get into the game of looking at individual companies, you have a process that you're going to keep no matter what, whether you're looking at a $30 million business or a $300 billion business or a $3 trillion business. Stick to the process where you're saying, this makes sense, I can understand it, and it checks everything. But if it doesn't do that, then you say, okay, it's too hard, and you just go, too tough, and you walk away. And I think that's something that's often overlooked by, Buffett and Munger, where they said most stocks go in the too hard pile. I think once you embrace having a outsized too hard pile in life, it just makes life a lot easier, especially for these more lottery ticket type of ideas where you go, oh my goodness, maybe there's a lot of upside. You need to get comfortable with the idea that I hope that it works out well for the executives and entrepreneurs at Safety Shot. I hope it works out well. I hope their company does well. And there's always, see, this gets to the Charlie Munger line. There's always going to be someone making money faster than you. I'm comfortable with that. But what I want to do is also have an investment journey owning businesses and stocks where I sleep well at night and I say, okay, this passes the full checklist. When I look at Safety Shot, it does not. And so goes in that too hard pile. I hope this video talk about how to think about a framework for assessing penny stocks has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.